In this video, our aim is to draw individual firms' demand and supply curve. We know that the market demand and supply curve is downward sloping and upward sloping straight lines. So this is demand curve, market demand curve, and this is market supply curve. This is the equilibrium point at which quantity demanded is equals to quantity supplied. Now suppose this is $50. Now here we consider the perfectly competitive market. So perfectly competitive market, which means competitive firms have no control over price. Okay, so if a particular firm increases the price slightly above $50, then most of the consumers will go to other firm, and if it decreases the price slightly below $50, then most of the consumer will go to this firm. So in this case, the demand for individual firms is perfectly elastic, right? So the demand curve is horizontal parallel to the x-axis, and this is perfectly elastic. Okay, so it is easier to draw the demand curve. Now let's look at how we can draw the supply curve. Supply curve is slightly complex. Before that, let's look at one example. Suppose there is a fortune cookies company. So there will be some factors of production for this company. Factors of production is an input used in the production of goods or services. Typically, there are two types of factors of production. One is fixed and the other is variable. So a fixed factor of production is an input whose quantity cannot be altered in the time horizon considered. So Q cannot be altered. And a variable factor of production is an input whose quantity can be altered in the time horizon considered. Now in economics, we do not specify the time horizon. Normally we say long run and short run. So long run is the time horizon in which there are no fixed factors. No fixed factors. So all factors are variable. Okay. And short run is the time horizon in which some factors are fixed. So some factors are fixed, and these factors cannot be changed. All right. Now let me cook up some numbers to make the example more concrete for this fortune cookies company. So suppose the number of employee is the only variable cost for this company. Number of employees per day. Okay, and we have total number of packs of cookies per day. So suppose there are 7 employees, and when there is 1 employee, the production is 40, 200, 3, 130, 4, 150, 6, 165, 7, 170. I think I did a mistake. Okay, let me write it again. So this is 100, 130, 150, 165, 175, 181. Okay, now let's calculate the marginal product. So marginal product is basically the marginal benefit or marginal output, you can say. So what is the marginal output when there is one employee? This is simply 40. For two employees, 60. 100 minus 40. This is 30, 20, 15, 10, and 6. Now you can see that the marginal product has initially increased and then decreased. Now this is against one of our assumptions from the previous video, that marginal benefit is non-increasing. Okay, so in this case it has increased in the beginning and then decreased. So it, the assumption can be flexible. It can be the case that marginal benefit is increasing as well. All right, and we call this kind of pattern as the law of diminishing returns. Law of diminishing returns. And this happens when there is at least some fixed factors. Okay, so at least some fixed factors. Okay, now suppose the fixed factor for this company is, fixed cost is $80 per day, and the employee wage is $24 per day. So employee wage is the variable cost. As you go on increasing the number of employees, the variable cost will also increase. Now let's calculate the company's output, variable cost, total cost, marginal cost for each level of employment. So everything. Okay, so we have 7 employees, 0, 1, 2, 3, 4, 5, 6, 7, and cookies per day. So the numbers are basically same as above. This is 0, 40, 100, 130, 150, 165, 175, 181. Now we have fixed cost. So this is 80. As you can see, fixed cost is $80. So this is all 80. Now what is the variable cost? So initially this is 0 and then 24, and for when there are 2 employees, this is 24 times 2. So this is simply 48, 72, 96, 120, 144, 168. Now what is the total cost? The total cost is the sum of the fixed cost and variable cost. So this is 80, 104, 128, 152, 176, 200, 224, 248. Now let's calculate the marginal cost per pack. So to calculate this marginal cost per pack, we do not consider the fixed cost because this is the sunk cost. Okay, so we are going to consider only the variable cost, okay, additional variable cost, and we'll divide it by the additional packs of cookies generated by the additional employee. Okay, so this is simply 24 divided by 40. Okay, so this is 0.6, and then as you can see, the additional variable cost is again 24, and the additional packs of cookies produced is 60, right? So this is 24 divided by 60, which is 0.4. Again, the additional variable cost is 24. Additional packs of cookies produced is 30. So 24 divided by 30, that is 0.8. Similarly, you can find other values. So this is 1.2, 1.6, 2.4, and 4.0. Now, suppose the price of one pack of cookies is $2.5. Okay, so this is the price. We can also call this as the marginal revenue, because when you sell one pack, you'll get this much money, right? So this is the marginal revenue per pack, right? Now my question is, when this is the price, then how many packs of cookies should this fortune cookies company produce when this is the price? So you'll compare the marginal revenue with the marginal cost, right? So as you can see, at this point, marginal cost is less than the marginal revenue, and if you go down, then the marginal cost becomes higher than the marginal revenue. So certainly you will choose to hire 6 employees and produce 175 packs of cookies per day. Okay, now there is another way of finding the number of employees and the cookies per day. So you can calculate the marginal cost per employee, marginal revenue per employee, and again you can compare the marginal revenue and the marginal cost per employee. You'll get the same answer. Okay, you'll get the 6 and 175. Okay, so let me do that as well, so that you'll understand much better. So I'm not going to copy the whole table. I'll only calculate the total cost. Okay, we have the total cost as well, so I only need marginal cost and marginal revenue. Okay, so let me do it this side. So marginal cost, so this is per employee. So marginal cost is simply $24, right? So this is 24. Now what is marginal revenue? So this is marginal revenue per employee. So this is 100, right? As you can see, the price is $2.5, and they can produce 40 packs per day. So when you multiply 40 times 2.5, this is simply 100. Okay, and then again, when there are 2 employees, the revenue is 100 times 2.5, which is $250. And when you subtract 100 from 250, you'll get 150, right? So the marginal revenue is 150. And then when there are 3 employees, you can simply multiply 130 by $2.5. You'll get some amount, and then you can subtract this amount, 150. Okay, 150 from that amount, so that will be your marginal revenue. So you can calculate the all other values. Okay, so this is 75, this is 50, 37.5, 25, 15. You can verify your calculations from these values. All right, so now you can see that here marginal cost and marginal revenue. So at this point, marginal cost is lower than the marginal revenue, but when you go down, the marginal cost becomes higher than the marginal revenue. So you would stop at this point, and you can see the number of employees the company should hire is 6, and the production is 175 packs per day. Okay, so you can be asked this kind of question in exam, so you better understand this. All right, now we can also calculate the profit for the company, so let's calculate that as well. So let me calculate the profit for the company. So profit. Now to calculate the profit, we need total revenue minus total cost, right? So we have the total cost, so these are the total cost. Now what is the total revenue? So total revenue, like when we calculate the marginal revenue, we also calculate the total revenue. Okay, so let me show you the total revenue calculation separately. So this is 2.5 times $2.5 time 40. Okay, so this is 100, and then you can multiply 100 times 2.5. So this is 250. Initially this is 0, then 250. Okay, and then you can multiply 130 times 2.5, which is 325, and you can calculate the other values as well. Okay, 375, 412.5, 437.5, and then 452.5. You can verify your calculation. Okay, now what is profit? So profit is total revenue minus total cost. So you simply do the subtraction, 100 times this value, right? Okay, so here you have 0, so 0 times, so 0 minus 80, so this is minus 80, then 100 minus, so this is minus 4. Okay, 122, 173, 199, and 212.5, 213.5, 24.5. Okay, so this is the profit. Now let me ask one more question. What is the producer surplus? Producer surplus. So what is the producer surplus? So to calculate the producer surplus, we do not take sunk cost into account. That is fixed cost. So fixed costs are sunk cost, and we do not consider this into our calculation. Okay, now while calculating the profit, we did take account of fixed cost, so we have to deduct that amount, fixed amount, from this profit. So what you can do is you can simply add 80. So you can see $80 is the fixed cost, so you can add 80 in all of these values. Okay, and the final value will be your producer surplus. Okay, so this is how you can obtain profit as well as producer surplus. Now let's plot the marginal cost in graph. Okay, marginal cost in graph with respect to the number of employees. So when you plot marginal cost in graph, you will see the graph something like this. Okay, so this is marginal cost, this is price, and this is quantity. Okay, now let's say there is some price. So this is the price. Okay, so the profit is maximized for a competitive firm. The profit is always maximized when price is equals to marginal cost. Okay, so profit is always maximized when price is equals to marginal cost at this point. All right, provided that the firm does not shut down in the short run. Okay, if firm shut down in the short run, then of course there will not be any profit, right? Now what are the conditions for firms to shut down in the short run? So let's look at the shutdown conditions. So firms shutdown condition in the short run. We'll also look at the long run. Okay, so when revenue from sales is um, okay smaller than its variable cost at all possible levels of output, then the firm will shut down in the short run. Okay, so when revenue from sales is less than variable cost at all possible levels of output, then the firms will shut down in the short run. Okay, please keep this in mind. This is for the short run. Okay, now what is revenue? So revenue is price times quantity. And what is variable cost? So let's write VC as the variable cost. Now you can transfer this Q to the right side. So P is less than variable cost divided by Q. Now what is this term? This is average variable cost, right? When you divide it by the quantity, that becomes average. So P is less than average variable cost. So you can also say firms will shut down in the short run when price is less than minimum level of average variable cost. Okay, so this is also the condition. One condition is revenue from sales is less than the variable cost, or price is less than the minimum level of average variable cost. Okay, so this is the condition for firms to shut down in the short run. All right, okay, now let's look at one graph. So this is the marginal cost curve, marginal cost, and this is the average variable cost curve. Okay, so there must be some relationship between MC and AVC. That's why I've drawn these curves in the same graph. Okay, now you can see that when MC is below AVC, so you can see MC is below AVC, the AVC curve is falling. And when MC is above AVC, the AVC curve is rising. So let me write here, when MC is below AVC, the AVC curve is falling. Okay, and when MC is above AVC, the AVC curve is rising. And the MC curve, the marginal cost curve, intersects average variable cost curve at its minimum point. Okay, so this is the minimum point of average variable cost curve, and the MC curve intersects at that point. All right, now you know that when the price is below the average variable cost curve, firms will shut down in the short run. There will not be any production, nothing. Okay, so when the price is below this level, okay, below this level, firms will shut down. So the supply curve will be the segment of MC curve, right? This whole MC curve will not be the supply curve, because when the price is below this point, there will not be any production, nothing. Firms will shut down in the short run. So this section, this segment of MC curve from this point is the supply curve. This is the supply curve for individual firms. All right, so this is the supply curve, and we know the demand curve, that is perfectly elastic. Okay, now what is the profit for the firm when the price, let's say the price is here, price is here. So what is the profit? So the profit is a total revenue minus total cost. All right, and what is total revenue? This is P times Q. And what is total cost? This is simply average variable cost times quantity, right? When you multiply average variable cost times quantity, this will give you the total cost. Okay, so now you can take Q common, so P minus AVC times Q. So this is the profit, right? So you can drop a line from this point to the AVC curve. Okay, so this is the point intersecting AVC. So P minus AV, so this is the level of P and this is the level of AVC. So P minus AVC is this region times quantity. So quantity is basically this section. Okay, so this area, this whole area will give you the profit. Okay, so this is how you can calculate the profit. I'll show you when we do some problems in the coming videos. Okay, then this will be very much clear for you. So for now you can remember this, that you can drop a line from the marginal cost to the average variable cost, and then you can find out the area of this region. Okay, so this will be your profit. And you also understood that the supply curve is the segment. Okay, so let me write here. So supply curve is the segment of MC, is the segment of MC that is above. Okay, so this is above AVC. It should be above. All right, now let's look at the long run. Now in the long run there are no fixed factors. All factors becomes variables. Okay, so in long run we do not have something called average variable cost. We only have average cost. Okay, there is no fixed cost. We only call it average cost. So profit becomes total revenue minus total cost, and in this case total revenue is price times quantity, total cost is average cost times quantity. So this is P minus AC times quantity. Now the graph will be pretty much similar to this. Let me draw it for you. There will be some difference. For example, in this graph you can see although in the graph it does not look that the AVC and MC has the same y-intercept, that is same price level, but it does have, these two curves does have the same price level in the beginning. Okay, it will start from the same y-intercept. And let me give you analogy so that you can understand. So for example, let's say there is one student in a class and his marks in one subject is suppose 80. Now my question is, what is the average and what is the marginal marks? So this is average, right? Because there is only one student, and this is also the marginal. Okay, so this is something like the, in the graph as well, the marginal and the average will be at the same point in the beginning. Okay, and then it will changes. But in the long run it will not be the same. They do not have the same point in the beginning. Okay, so this is our marginal cost. All right, and this is the average variable cost. So this is average variable cost, this is marginal cost. Okay, now suppose the price is at this level. Suppose this is $50. Let's say this is $50. Okay, and at this point it should be MR equals to P, price. Okay, Now to get the profit, we know P, okay, so this is AC, there is no average variable, this is simply average cost because there are no fixed cost, everything is variable, so we normally call this average cost. Okay, we do not call the average variable cost, or even if you call the average variable cost, then this is simply the equal. Average variable cost is equals to average cost in the long run. Now you need to drop a line to the average cost. Okay, and now I think the graph is a bit weird. Let me draw it again. So something like that. All right, so what is the profit? So when you drop a line to the average cost, so this is the average cost, and you can find out the area of this region. Okay, so this will be your profit in the long run. All right, so calculation is pretty much similar. So this is P minus AC and this is quantity. All right, so this is how you can obtain the profit in the short run and long run. And again, you can analyze from the graph that when MC is below AC, the AC curve is falling. AC curve is falling. Okay, and when MC is above AC, the AC curve is rising. And when the MC curve intersects the AC curve at its minimum point. Okay, so MC will intersect the AC at its minimum point. All right, and to sort down in the long run, we normally call firms will exit or enter in the industry in the long run. We do not call the firms will shut down. Okay, so when it comes to long run, we normally call firms will either exit or enter the industry. Although this is same as saying the shutdown, but we normally call firms will either exit or enter the industry in the long run. And what is the condition? So condition is pretty much same. In this case, you have average cost, so price should be less than minimum value of average cost. Okay, so the firm will exit the industry when the price is less than the minimum level of average cost, and firms will enter the industry when the price is above minimum level of average cost. All right, so this is all about individual firms demand and supply curve. Okay, so this is the supply curve and the demand curve is perfectly elastic. So now let's stop here, and I'll see you in the next video with some other concepts of microeconomics, and we'll do some more questions in the coming videos. Okay, so thank you so much for watching this video.